Here's the problem with term insurance. There's no cash value, so you cannot use term insurance to become your own bank, like I talk about. It cannot be used because there's no cash value. It's just a death benefit. If you die during that term, your family gets the death benefit. Problem is, the insurance company knows you're probably not going to die during that term or they wouldn't insure you. Now, whole life makes so much more sense, even though the Dave Ramseys of the world say buy term and invest the difference. Again, that's not a great thing to do because if you invest the difference, guess what? There's no guarantee you're going to make money. If you don't know what you're doing, you're probably going to lose money. I learned this 4 or 5 years ago. And now that I know it, I was able to set up the foundation of everything within the first couple of years. Now, my family is set for my life, for my kids' lives, for my grandkids' lives, for my great grandkids, so on and so forth. The family will continue to get wealthier and wealthier and wealthier because of the tree I planted today.
This is the Mr. Burr Show.
Welcome back to the show, everybody. Today, in this episode, we are going to talk about the difference between term insurance and whole life insurance, and why I think that term insurance is the worst kind of insurance you can get, and why whole life should be the one that you choose, especially when it's designed for infinite banking. So let's jump right into it. Before we do so, if you are watching this on YouTube and you are not subscribed to my channel, make sure to do so. Hit the bell so you get notified when I put out these videos, and give it a thumbs up because the algorithm loves it. So without further ado, let's jump in. Term insurance and whole life insurance. So at the end of the day, here's the way you have to look at things. We are guaranteed to die. I mean, I hate to be morbid, but it's true. We are guaranteed to pass away at some point. We just don't know when it's going to happen. So because of that, because of the fact that it is a guaranteed thing, you are going to die someday, it only makes sense to insure your greatest asset. What is your greatest asset? It is your ability to go provide value in the world, your ability to go make money for you and your family. That's your greatest asset. It's not any kind of house. It's not any kind of cryptocurrency. It's not anything else. It's not a business. It is you. You are your greatest asset. So it only makes sense to insure that asset in case you prematurely pass away. If that happens, you can't make money for your family anymore. So you want to make sure that they're taken care of if you pass away prematurely. Here's the thing. You're going to die someday, so you might as well insure your life for your whole life. That's the difference. So whole life is a permanent policy. It pays out when you die, not if, when. With term insurance, it only pays out during the term that you do. So if you do a 10-year term, a 15, a 20, whatever, if you die during that time, the insurance company pays the death benefit to your family. Here's the problem with term insurance. There's no cash value, so you cannot use term insurance to become your own bank, like I talk about. It cannot be used because there's no cash value. It's just a death benefit. If you die during that term, your family gets the death benefit. Problem is, the insurance company knows you're probably not going to die during that term or they wouldn't insure you. So most people, what they do is they get a term insurance policy usually around the age of 30 when they buy their first home, these kind of things. So if you're 30 years old and let's say you get a 20-year term insurance policy, it's good till you're 50. The insurance company knows the likelihood that you're going to die before 50 is very slim, or else they wouldn't insure you. So it's very cheap to have term insurance for those 20 years. Let's say it's $50 a month, just throwing a number out there. Then you hit 50, you outlive that term, which, by the way, happens 99% of the time, meaning that The insured person does not die during that term. They outlive it. So the insurance company collected all of those premiums for 20 years. They did not have to pay the death claim because you did not pass away during that term. Now you're 50 years old. You want to get that same coverage on your life, the same amount of insurance. So you do the same amount. Let's say it's $1 million death benefit. Just again, throwing an arbitrary number out there. Now you're covered from 50 to 70. You're more likely to die from 50 to 70 than you were from 30 to 50. So what happens? The insurance company calculates risk. They know you're more likely to die during that term. So what they do? They jack the price up. So it's no longer $50 a month. It might be 150, $200 a month, but you get it anyways. It does not build any cash value. So again, you're just getting a death benefit if you pass away during that term. So what happens is for 20 more years, you're paying 150, 200 a month, whatever it is, and you outlive the term. Again, this happens 99% of the time. People outlive their term insurance. So then you're 70 years old now. You want to get that same $1 million death benefit. Now, if you get another 20-year term from 70 to 90, you're really, really likely to die during that time frame. The insurance company knows that. So what do? They jack up those premiums. Those premiums might be 1,000, 1,500 a month, 2,000 a month. You can't afford it at that point. You cannot afford to have the coverage. So then you don't get it. And what happens? You die during that term. So then your family doesn't get any death benefit. For 40 years of your life, you paid into a policy, a bill, and nothing was ever paid out. Term insurance is actually the most profitable insurance for an insurance company because it only pays out 1% of the time. So it's very, very profitable. I think term insurance, because of those reasons I just gave, is the worst kind of insurance you can have. Now, whole life makes so much more sense, even though the Dave Ramseys of the world say buy term and invest the difference. Again, that's not a great thing to do because if you invest the difference, guess what? There's no guarantee you're going to make money. If you don't know what you're doing, you're probably going to lose money. And then you're going to be paying into this insurance policy for 20, 40 years of your life, and it's never going to pay out. So that's not a great strategy. Sorry to break it to you, Dave Ramsey. But if you have a whole life insurance policy, what happens is it is your whole life. So when you die, when it happens, your family will get a death benefit, tax free. So you are insuring something that is guaranteed to happen. When you die, when you pass away, your family will be taken care of, tax free. That is kind of at a surface level, bird's eye view. That's life insurance. It's protecting your family when you pass away. Whole life does it for your whole life. Term does it for just a certain term. With whole life insurance, the beauty of it is as you put money in, it's building equity. Think of equity as like equity in a house. When you make a payment on a house, you're building equity in the house. You can then borrow from that equity. It's the same thing with whole life. When you put money into a whole life insurance policy, over time, it builds equity in the form of cash value. And what that means is the insurance company is allowing you to borrow from your future death benefit. And because you're borrowing from something that's inevitably going to happen, you never have to repay your policy loans. So like, let's say you've got $100,000 in cash value. You can borrow that from the insurance company's general funds. You're borrowing from your future death benefit. Let's say the death benefit's $1 million. You borrow 100 grand and you never pay it back. The insurance company just won't give that 100 grand to your family when you pass away. If let's say the death benefit's $1 million, they'll pay out 900 instead of $1 million because you used 100 grand while you were alive. It's called life insurance, not death insurance. So If it's done correctly, it can and should be used while you're alive. So, whole life insurance builds cash value, equity that you can use by taking a loan against your future death benefit that you never had to pay back. And because you're borrowing from your policy, you're not removing the cash that you're putting in, your your cash continues to compound and grow. So you're not interrupting the eighth wonder of the world. Einstein called compound interest the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. So if you can put into a policy that's guaranteed to compound and grow, and then you can borrow against it tax free because loans are never taxed, and then use that money to go make more in investments in your business, to buy cars, to take trips, to do whatever you're going to do with money anyways, while your money keeps compounding. And then when you pass away, it's inevitably going to happen, your family gets the tax-free death benefit minus any kind of loans that you use throughout your life. And the beauty of it is your death benefit is always higher than your cash value. Therefore, your family's always going to get something tax free when you die. I cannot stress that enough. It's going to happen to all of us. So when it happens, your family's taken care of. Here's the way I look at it. If I'm putting money into a policy, it's guaranteed to compound and grow. That means I can always use more the next year because it's always growing. So I can always borrow more, right? Think of it like a house. If the house always goes up in value, it's always got more equity. Therefore, I can always use more equity. And if it doesn't devalue the house, if the value of the house keeps going up, I can just keep using more and more and more. Make sense? So the way I look at it is I'm going to put as much as I can into a policy as early in my life as possible. That way it has the longest amount to compound and grow. And then I'm going to use it to go buy assets, to go buy things that are going to bring me in more money, real estate, private lending, whatever it may be. So here's the way I look at it. Let's say when I'm likely to die, 80, 90 years old, whatever it may be. If my death benefit at the time, let's use arbitrary numbers, let's say it's 30 million bucks. $30 million. And let's say throughout my life, I used 15 million of that to go be the bank, to go do private lending deals, to go buy real estate, whatever it may be. My family, when I die, will get the death benefit minus the 15 million because I didn't pay it back. So they'll get $15 million tax free. They'll also get everything I bought with the other 15 million. So if I went and bought a bunch of real estate, they're going to get those real estate properties. And if I did it correctly, they're going to get those real estate properties tax free. So now they've got cash flowing assets that I use to buy with an asset tax free. They're getting a death benefit paid to them tax free. If it's structured correctly inside of a foundation and a trust, then that trust can dictate that the tax-free money from the death benefit goes into buying more life insurance that grows tax-free, that my family can use tax-free by borrowing against it. And then when they die, the death benefits are paid into the trust. The trust has all this tax-free money. It buys policies on their kids, my grandkids. They grow tax-free. They can use it tax-free. Do you see how this works, guys? It just takes a little bit of knowledge on how it works. And then it takes setting it up. You obviously have to set up the foundation. I learned this stuff when I was 34 years old. I just turned 39. So I didn't learn this stuff a long time ago. I learned this 4 or 5 years ago. And now that I know it, I was able to set up the foundation of everything within the first couple of years. Now, my family is set for my life, for my kids' lives, for my grandkids' lives, for my great grandkids, so on and so forth. The family will continue to get wealthier and wealthier and wealthier because of the tree I planted today, or I should say 4 years ago. So I hope this helps you guys understand the difference between whole life and term, why term really isn't a good way to go when it comes to insurance, because you're just renting it. You're just renting an insurance policy that, by statistics, probably won't pay out to your family. Here's one thing I'll leave you guys with. This is a thought that I always have when someone does a term insurance. They're making a bet. Like if you buy a term insurance policy, you're making a bet with the insurance company. That bet is that you are going to die during that term. That's your bet. You're going to die during that term. The insurance company is going to have to pay out that death claim, the life insurance, the death benefit. That's your bet. Their bet is that you're going to outlive the term and they're not going to have to pay out the death claim, and they're going to get all those premiums for that term, 5, 10, 20, whatever it is, years. They win that bet 99% of the time. You as a policy holder, you win that bet, if you can consider dying winning the bet, 1% of the time. It makes no sense to have a term insurance. It's the most profitable for the insurance company for obvious reasons. They only have to pay out 1%, and most people do term insurance. So they're getting a lot of premiums and never having to pay out those death claims, or I should say never, just 1% of the time. So I hope this helps you guys realize the difference between term insurance and whole life insurance, the fact that whole life is a better route to go. Whole life should be structured correctly. It's most people don't know how to structure it correctly. It should be structured to have high cash value, so that way you can use the money you're putting in. You can use it right away to go make more money, like I talk about, while it continues to compound and grow at the same time within your policy. Within a life insurance policy as well, the money is protected against lawsuits and judgments. So therefore, if you're putting most of your money into a whole life insurance policy, it's protected there. It's not protected in your bank. If you get sued, you can have your money taken from your bank account on judgments and lawsuits. Can't happen inside of a whole life insurance policy. It's protected against lawsuits and judgments in most states. So it is a better place to store your capital. It is a better place to multiply money because it's going to grow in the policy, guaranteed. Then you can borrow against it and go grow it elsewhere at the same exact time. It's the only financial tool that lets you do that because it's the only one that's guaranteed to grow while you can borrow against it and never have a repayment term. Meaning, again, I said this at the beginning, insurance company knows you're going to die. You don't have to pay back your loans because if you don't, they're just going to deduct it from your future death benefit. So I hope this helps you guys. If so, go ahead and send it off to someone else. Drop some comments. Let me know what else you guys want to learn about, what you want to hear about, and I will put it out on the show and make sure I give you guys as much value as possible. I'm doing these solo episodes now because, guys, I had my second daughter 3 months ago, and I'm trying to spend as much time with her as possible. So I'm not going to the studio and bringing on guests right now to the show. I'm just doing these solo episodes in my home office, spending a couple hours working a day, and the rest of the time I'm spending with my family. So I love and appreciate you guys. Let me know what else you want to hear about. If you haven't subscribed to the channel, make sure to do that. Until next time, I love you guys. Peace.